Welcome to our channel. Today we're going to discuss one of the most effective trading strategies known as the imbalance formation. You'll learn how major market players leave their marks on charts, which often go unnoticed by beginners, and how these signals can be used to open profitable trades. We'll also break down a step-by-step action algorithm and examine examples of working setups suitable for various markets, whether it's cryptocurrencies, stock instruments, currencies, or even commodities. Although the price movements of oil and Bitcoin may differ, the principles of price formation remain consistent. Real examples will show that this strategy truly delivers results. If you're just beginning your journey in the world of cryptocurrencies, or you're an experienced trader looking for more unique information, be sure to check out our Telegram channel. There you'll find not only the latest news and promising investment projects, but also quality analysis from experienced professionals who share their ideas in our free chat. Don't miss the chance to become part of our community. Click the link in the description and join us. Let's dive into what imbalance is. Simply put, it's an area on the chart where a gap forms between the wicks of 3 consecutive candles. The color of these candles doesn't matter. In a bullish scenario, the upper wick of the first candle doesn't reach the lower wick of the third, leaving an empty space that indicates a sudden market gap. In practice, this means that buyers suddenly became active and sellers couldn't react in time. As a result, the price spiked, leaving a gap between the wicks of the first and third candles. This zone on the chart shows that either no trades were conducted or their volume was insignificant. The main reason for such imbalances is the activity of major players such as banks and funds. They enter the market with large orders, and the market can't react quickly enough. This leads to a sharp price jump, reflecting the market's attempt to handle the suddenly appeared volume. These zones are important for analysis because prices often return to them to restore balance and offer a fair value for all participants. Simply put, the market strives for equilibrium. When analyzing a chart, first look for imbalance zones. They indicate the movement of large capital. By following the actions of institutional players, you increase your chances of successful trades. Let's break down the main terms related to imbalance. They are often labeled as FVG, fair value gap, which means a gap in fair value. These zones are also called price inefficiency. In effective pricing, such gaps don't exist and the price is evenly distributed. All these terms describe the same phenomenon, a gap caused by a demand and supply imbalance. In terms of pricing, imbalance attracts price like a magnet. The market usually aims to return to these areas to restore equilibrium. Additionally, imbalance serves as a strong support zone. When the price reaches this level, a reaction is expected, after which the market is likely to continue following the trend. For traders, these are excellent points for opening positions. Now, let's look at a chart on a smaller time frame. Here, you can notice another imbalance within a larger one. This pattern is common. Price inefficiencies appear across all time frame levels. Identifying intersections of these zones can help more accurately predict the level at which the price might react. Revisiting the analysis, it becomes clear that the inner imbalance again attracts price and acts as support from which positions can be opened. This zone is highlighted because the range between swing levels below the imbalance holds more significance for price movement. As is well known, higher time frames have a greater influence on the market than lower ones. This rule is confirmed in practice. Consider a scenario where active selling by major players begins from the upper candle. The selling pressure is so great that demand is significantly lower. This is a clear indication of imbalance formation, visible on the chart from the minimum of the previous candle to the maximum of the next. Its appearance is an early and powerful signal of the onset of a downtrend. The market usually seeks to restore the disrupted balance before continuing the downward movement, which leads to a decline into the area of the lower imbalance. Once this zone is balanced, the uptrend can regain strength. Now let's examine how a bearish imbalance develops. We observe a sharp price drop into the hourly and 15-minute imbalance zones. At this stage, the price stalls, filling gaps and processing unfilled orders. After this, the uptrend resumes. The examples we've considered demonstrate universal laws of price movement applicable in all markets, whether cryptocurrencies, stocks, or commodities. By understanding this concept, you can predict major price movements in the future with high probability. Let's explore how to correctly identify an imbalance within another imbalance. For this, it's useful to use a time frame grid adapted to the current market situation. For example, to detail a monthly imbalance, it's best to use weekly and daily timeframes. Shifting to smaller intervals may reduce analysis accuracy. This principle applies to other timeframes according to the chart. Let's consider an example of refining a monthly imbalance on a daily timeframe. This approach not only narrows the potential zone of interest, but also enhances forecasting accuracy. You minimize risks and increase the likelihood of successful trades by focusing on key levels, where a price reaction is most likely to occur, avoiding chaotic searches for reversal points. Apply the same logic to other frames, moving to smaller timeframes to refine zones of interest and conduct a detailed analysis. Now, let's discuss how to choose the most suitable imbalance for trading. Often on the chart, you may notice 2 bearish imbalances forming as the price decreases. At first glance, they might seem equally significant, but the correct choice depends on their market position. To assess potential, we turn to the concept of premium and discount zones. How to do this? Apply a Fibonacci grid from the peak where the decline started to the correction minimum. The 0.5 level in this grid is the balance line, indicating the fair value of the asset. Everything above is the premium zone, where the price is overvalued, and below is the discount zone, where assets are traded at a discount. In the premium zone, major players like funds and banks try to sell assets favorably before further declines. Therefore, the second imbalance, located above the 0.5 level, usually has greater potential for completion. It is reinforced by the actions of major players and is more likely to trigger a price reaction than the first one in the discount zone. Remember, the market strives for equilibrium, returning to the 0.5 level where supply and demand are balanced. Ignoring zones in the discount minimizes risks and enhances trading efficiency, increasing the risk-reward ratio. This approach allows focusing on more promising trades, ensuring stable results and greater profit over the long term. In a long scenario, the approach is similar, but the focus is on purchases in the discount zone, where assets are available at a reduced price. All imbalances encountered along the correction path and located in the premium market zone should be ignored, as the chance of their successful completion is extremely low. However, if an imbalance covers both zones, premium and discount, it is more promising. Such situations occur quite often. In this strategy, work only with the part of the imbalance below the 0.5 level, making it the first zone of interest for opening a long position. If an imbalance is deep in the discount market zone, it becomes an additional point for opening a position if the price does not reverse from the first zone. This approach helps to reduce risks and increase the chances of a successful trade. On the chart, you can see how the price methodically tests the highlighted zones, bouncing off key levels and forming an uptrend. This demonstrates how correctly identified zones of interest can contribute to accurate market movement forecasting. In summary, regarding premium and discount zones, it's important to note that this approach is considered a conservative strategy. However, sometimes the price can move too quickly, not returning to fair value during a correction, which might lead to missed opportunities. Nevertheless, despite this drawback, the strategy provides stable and predictable results in the long term. If your goal is stability rather than catching every move, this strategy will be your reliable ally. Now let's move on to creating a simple and effective trading setup based on imbalance. The table we mentioned earlier presents successful combinations of timeframes suitable for analyzing almost any chart. For example, start with the daily timeframe, where the main work is done, determining the overall market direction, key liquidity levels, and imbalance zones. Then move to a lower timeframe, in this case hourly, to refine daily imbalances, find reversal formations, and enter the trade. This sequential and structured approach allows finding frequent and high probability setups based on market logic and the actions of major players. Next, we'll break down each of these steps in detail. You'll learn what to focus on before opening a trade, how to correctly choose entry points based on the imbalance, and how to effectively place stop losses and take profits. The first and perhaps most important step is determining the market direction on the higher time frame. This requires analyzing the market structure, considering unfilled imbalances and unused liquidity pools. Let's look at an example where an uptrend is visible on the chart, consisting of 5 candles. Important elements to pay attention to are the latest higher high and higher low. They form a trading range that sets the boundaries for the current correction. Interestingly, within an uptrend, a downward movement can occur, a phenomenon you will often notice. Such movements are often initiated by major players to increase market liquidity. Above each high, buy orders accumulate, and below each low, which is taken out during the correction, sell orders concentrate. These orders are used by large institutions to open long positions and subsequently drive asset growth. The support of the trend by major participants indicates its strength. Therefore, the next important step is to determine the end of the corrective cycle and the targets for further growth. Next, highlight key price levels. In our example, these are the equal highs and lows. Such levels are created specifically to attract the capital of less informed traders, which is then used by smart money to achieve their goals. It's important to understand that for smart money, these levels are not just support and resistance, but zones of high liquidity concentration that will inevitably be breached. Liquidity is the driving force behind any market movement. The market moves cyclically, transitioning from one liquidity zone to another, creating patterns observed in all markets and timeframes. To better understand this dynamic, it's crucial to study the concept of internal and external liquidity. This will provide a clear understanding of how and why price moves. Understanding these processes is key to stable and profitable trading. Consider a classic uptrend. Its key elements mark areas of external liquidity accumulation, while internal liquidity includes all the swings between the current higher low and higher high. The mechanics of an uptrend are simple. First, there is a removal of external liquidity associated with buying, forming a new high. This reduces the available funds in the market and necessitates the redistribution of the asset in the opposite direction. During a correction, the market performs 2 tasks. It removes internal pools of sell liquidity and eliminates previous price inefficiencies. These actions encourage traders to open new positions, saturating the market with the liquidity large participants need to continue the trend. The cycle concludes with the price moving to a new zone of external liquidity, after which the process repeats. This is a continuous dynamic based on changes in market liquidity. It's important to remember that after external liquidity is taken, the price seeks internal liquidity and vice versa. This cyclical process can be predicted. Based on this, we can anticipate price movements towards internal liquidity pools, further reversal, and asset growth towards external liquidity zones. To refine these forecasts, add a third step in the analysis, determining available imbalances, which will become zones of interest for opening positions. The first imbalance is located in the discount zone and has important factors enhancing its significance. Above it are accumulated internal pools of sell liquidity, providing large players with an excellent opportunity for active buying at attractive prices before continuing the trend. The second imbalance is bearish, formed within the current price range. Its appearance signals the intention of institutional players to push the price even lower, which can be used for short-term short positions, aiming for a return to the first imbalance. The third imbalance is located above the external buy liquidity zone. This is the FTA, or the first trouble area on the path of upward movement, where a price reaction can be expected. It will likely lead to a correction during which internal sell liquidity pools will be cleared. Thus, just a few steps allow you to construct a high-probability price movement plan for the coming days. We await the rebalancing of the bearish imbalance and consider opening short positions. Inside the bullish imbalance, we look for a reversal and open long positions. Our goal is to update the last high and reach the area of the third imbalance, from which shorts can be considered again. Next, switch to a lower time frame to refine the zones of interest and increase the probability of success. Switching to a lower time frame helps with 3 key tasks: refining the zone of interest, confirming the reversal, and finding the optimal entry point. In the example of a 15-minute time frame, first refine the previously noted imbalance zones to narrow down the areas of interest where we expect price reactions. This allows us to adjust the trading plan made on the higher time frame. For a local short position, for example, we aim for the minute imbalance zone, where a reversal and price decline are likely. The target is the start of the 15-minute bullish imbalance, which could become an upward reversal zone. To confirm the reversal, focus on 3 factors: the removal of buy liquidity, a sharp price drop breaking the structure, and the formation of a new bearish imbalance indicating a downward movement. Even if the structure break doesn't occur, the bearish imbalance itself is a sufficient early reversal signal. In this case, place a limit order to enter short at the beginning of the zone of interest. Set a conservative stop loss above the last high, and the take profit at the start of the 15-minute bullish imbalance. Partial profit taking can be done when internal sell liquidity is removed. This approach achieves a risk-to-reward ratio of 1:6, which is an excellent result. As practice shows, the price often moves perfectly between institutional zones of interest, and trades complete within a few hours. When considering opening long positions, you can choose between aggressive and conservative approaches. In the first case, place a limit order at the start of the 15-minute imbalance and set a stop loss below the low of the second candle on the 4-hour time frame. Targets are the nearest previous high and the start of the bearish imbalance. This approach does not require reversal confirmation and is based on analysis. With a conservative approach, it's better to wait for a local break of structure and look for an entry point on the correction. For example, after a reversal, the main target becomes the support zone in the discount market. On a 5-minute time frame, refining the zones enhances accuracy. Within an order block, you might notice a small price inefficiency, reaching which indicates a reversal and the possibility of entering long. Each order block on lower time frames should include zones of interest, as these trigger price reactions. Successful testing of an order block involves the removal of sell liquidity, a break of structure in the opposite direction, and the formation of a new zone of interest from which a position can be entered. Place a limit buy order at the start of the imbalance. For a stop loss, there are 2 options: below the nearest low for an aggressive approach, or behind the last swing for a more conservative one. Targets are set at levels from the higher time frame or locally, such as the last high from which the correction began. Thus, setups based on analyzing both higher and lower time frames demonstrate high accuracy and effectiveness. These simple steps will help find profitable trading solutions. If anything remains unclear, review the points again and leave a comment. We'll definitely help you figure it out. Remember that any strategy should first be tested on a demo account before moving to real trades. This will strengthen your skills, confidence, and improve results. And finally, don't miss the chance to be at the center of events. Our Telegram channel is your ticket to the big leagues of the crypto world. Just imagine, exclusive analytics, fresh insights, trades from pros, and all of it absolutely free. While others are guessing where the market will move, you're already acting with confidence, relying on knowledge and proven strategies. We know how to explain the complex in simple terms, just the way it should be. So don't waste time. Click the link in the description and join our crypto team. Better to be riding the wave than struggling against the current. See you in the chat and in the next video.